You swipe a piece of plastic at the grocery store. A $47 charge. Nothing dramatic. Just another transaction in another week. But behind that swipe is a system designed to make sure that $47 costs you far more than $47, and that the extra money flows, with mathematical precision, into the pockets of companies that knew exactly what they were building. Americans now carry $1.277 trillion in credit card debt. That is more than the GDP of Mexico. It is spread across roughly 191 million cardholders, nearly every adult in the country. The average cardholder carries a balance of over $6,500, and the average APR on a new credit card offer sits above 24%, not 10%, not 15%, 24%. That number is not random. It is the result of decades of deliberate design. Here is how the trap works. Credit card interest compounds daily, not monthly, not annually. Every single day, the interest on your balance is calculated and added to what you owe. You don't notice it because the statement shows a single monthly total. But behind that number, the math is grinding, quietly, relentlessly. A 24% APR divided by 365 days means your balance grows by roughly 0.066% every day. On a $6,500 balance, that is $4.28 per day, $128 per month, $1,538 per year in pure interest, before you pay down a single dollar of principal. Now consider the minimum payment. It is typically 1% to 2% of your balance plus interest. On that same $6,500 card, your minimum payment might be around $175. Of that $175, roughly $128 goes to interest. Only $47 goes toward reducing what you actually owe. You are paying the bank more than 2.5 times what you are paying yourself. But interest is only half the story. The other half is fees, late fees, over-limit fees, balance transfer fees, cash advance fees, annual fees. In 2025, Americans paid $253 billion in interest and fees combined. Credit card companies call these revenue streams, and they have engineered each one with precision. Late fees alone generate roughly $12 billion a year for card issuers. The average late fee is around $30, and the system is designed to trigger it. Payment due dates shift. Cutoff times are arbitrary. A payment submitted at 5:01 p.m. on the due date is counted as late, not because the money isn't there, because the rule was written to capture it. Credit card companies do not just profit from the math, they profit from the psychology. The minimum payment is not a suggestion. It is a trap. It feels manageable. $175 a month feels affordable. And that is exactly the point. A manageable payment keeps you paying, and paying, and paying for years, for decades. The industry has studied this. Behavioral economists call it present bias, the tendency to value immediate relief over long-term cost. Credit card companies have built their entire pricing structure around this human tendency. Low minimums feel like relief. High interest ensures you never escape. The system exploits not your stupidity, but your humanity. If you're finding this useful, subscribe. Every week we pull back the curtain on a different piece of the financial system, and these stories only matter if people see them. And like every systemic failure we've covered on this channel, the credit card trap does not fall equally. Black and Hispanic Americans carry disproportionately higher credit card debt. Low-income households are more likely to carry balances month to month, and they are charged higher interest rates, not because they are higher risk in any meaningful sense, but because the system targets them. Research shows that even when controlling for credit score and income, Black borrowers are offered higher interest rates on credit cards than white borrowers with identical profiles. The discrimination is embedded in the algorithms. It is embedded in the marketing. Credit card companies spend heavily targeting lower-income neighborhoods with offers that carry the highest interest rates and the lowest credit limits. They are not lending to help. They are lending to profit. The entire credit card industry rests on a single, uncomfortable truth. The people who pay the most are the people who can least afford to pay. Transactors, people who pay their balance in full every month, generate almost no profit for card issuers. They get rewards, points, cash back, all funded by the far more lucrative group, revolvers, the people who carry balances, the people who pay interest, the people who make minimum payments. Credit card companies call them their most valuable customers. In 2024, U.S. bank credit card profits totaled approximately $268 billion. The top 10 card issuers account for over 80% of the market. J.P. Morgan Chase alone holds roughly $170 billion in credit card loans on its balance sheet. This is not a fringe industry. It is one of the most profitable sectors in the entire American economy, and its profits are derived, by mathematical design, from the financial stress of millions of households. And here is where the system becomes truly insidious. In 1978, the Supreme Court decided a case called Marquette National Bank v. First of Omaha Service Corp. The ruling allowed national banks to charge whatever interest rate was permitted in the state where the bank was headquartered, regardless of where the borrower lived. South Dakota had no interest rate cap. Delaware had no interest rate cap. So banks simply moved their credit card operations to those states. Overnight, every state cap in America became meaningless. A law designed to protect consumers was nullified by a single court decision and a couple of friendly state legislatures. This is why your credit card APR can be 24%, 29%, 34%. It is not market forces. It is not competition. It is a legal loophole that has been exploited for nearly half a century. The credit card industry did not stumble into profitability. It engineered it. Every APR, every minimum payment formula, every fee structure, every marketing strategy targeting vulnerable neighborhoods, these are not accidents. They are features of a system that generates $253 billion a year by turning financial stress into revenue. The least you can do, the most powerful first step, is understand exactly how it works. If this video gave you a clearer picture, share it with someone who needs to see it. Next week, we're going to show you how the healthcare industry turns your medical bills into someone else's profit center, and why being sick in America is a financial decision before it is a medical one. Subscribe so you don't miss it. We'll see you then.